Welcome to Trade FX Club, your go-to spot for smart, easy-to-follow updates on the Forex market. Today, we're taking a closer look at the pound sterling, which has made a notable move higher, climbing to around 1.3330 against the US dollar. This rise comes after some weak economic data out of the United States put pressure on the dollar. Let's start with what's happening in the US. The latest Producer Price Index, or PPI, came in softer than expected. Prices fell compared to the previous month, largely because of a significant drop in hospitality services, things like airline tickets, hotel bookings, and other travel-related services. The slowdown is reportedly tied to a decline in tourism, with some international travelers avoiding the U.S. over concerns related to trade policies, immigration issues, and controversial political statements. Retail sales also disappointed, rising just 0.1% in April. That's a big step down from the strong 1.5% seen in March. It looks like American consumers went on a shopping spree in March, likely in anticipation of tariffs or price hikes that didn't materialize. But by April, spending slowed dramatically. Car sales fell slightly, and growth in durable goods was also weaker than before. As a result of all this, 10-year U.S. Treasury yields dropped from a recent high of 4.55% to around 4.40%. Despite the soft data, markets still expect the Federal Reserve to keep interest rates unchanged in both the June and July meetings. According to the CME FedWatch tool, there's about a 92% chance the Fed holds rates steady next month, and over 60% for July. It seems the Fed is more focused on anchoring inflation expectations than reacting to short-term dips in data. Now let's turn to the UK, where the pound sterling has been gaining momentum. Thursday's strong GDP report showed the British economy grew faster than expected in both the monthly and quarterly figures. That news gave traders more confidence that the UK economy might be strong enough to handle elevated interest rates a bit longer, especially if inflation sticks around. Bank of England chief economist Hugh Pill added to that view, saying he's still worried inflation could prove stubborn. He pointed to long-term shifts in how wages and prices are set, something we haven't really seen since the 1970s and 80s. Because of that, he thinks there's still a strong case for keeping rates higher for longer. Pill was actually one of only 2 Monetary Policy Committee members who voted against the bank's recent 25 basis point rate cut, which brought the main rate down to 4.25%. His comments suggest that if inflation remains high, the BOE could pause further rate cuts or even rethink their path forward. But of course, all eyes are now on the upcoming UK CPI report, which is set to be released this Wednesday. If inflation shows signs of easing, that could give the BOE more room to cut rates again in June. If it stays high or surprises to the upside, we could see those expectations shift quickly. On the technical side, GBPUSD is showing strength, holding above 1.3300 and staying above the 20-day exponential moving average, which is currently around 1.3256. That signals a bullish trend in the short term. The relative strength index is hovering in neutral territory, but a break above 60 could bring in fresh buying interest. Looking ahead, the major resistance is around the 3-year high at 1.3445, while support is expected near the psychological level of 1.3000. In summary, the pound is riding on a wave of stronger UK data and weakness in the US dollar. But with inflation data coming up and central banks still trying to strike a balance between growth and price stability, the story is far from over. If you found this breakdown helpful, make sure to like this video, subscribe to Trade FX Club, and turn on notifications so you stay ahead of every market shift. Thanks for watching, and we'll see you in the next update.